James Longsdon is Managing Director of Financial Institutions at Fitch Ratings. He joins us live from Singapore, where Fitch's annual Global Banking Conference is taking place. Thank you so much for joining us, sir. I want to start by asking you about those comments by investor George Soros that Germany's fiscal policy is somewhat selfish, potentially throwing the Eurozone into crisis, into a deflationary spiral, possibly.
Well, certainly we're certainly finding, particularly for the banks in Europe, we're finding certainly one of the significant challenges that's affected them, particularly over the last 2 months, has been knock-on effects, I guess, from the sovereign peripheral country crisis, in terms that we have seen very, very significant contraction in the access to the public debt markets. By some measures, only $3 billion of public debt issuance in May, relative to a first quarter 2010 of something like $200 billion, and also likewise into the shorter-term funding markets as well. And from that perspective, clearly we feel that it's very important, it's very likely that the central bank there, the ECB, will have to keep its very accommodative policy going.
And now the G20 meeting, of course, is due to get underway this weekend in Toronto. I want to ask you about proposals by the governments of Germany, the UK, France on a new levy to be introduced on banks next year. How do you think that tax is going to impact on the banks?
To be honest, I don't think it's going to be a very big impact at all. Certainly the sort of size we've seen from the UK, a number banded around of about £2 billion, that quite simply isn't going to be a big enough concern. It's certainly not going to affect the credit ratings in itself. I think more importantly, though, potentially the thing it is also not going to do, I don't think it's going to fundamentally change the way the banks finance their business. Certainly it seems to be well targeted in the fact it is targeting particularly some of the shorter term financing, which has proven more volatile. But it's just not going to be big enough. It's somewhat marginal, I think. It's just not going to be big enough to transform some of that sort of funding issues that some banks have had.
How important is it for there to be international cooperation on this levy in order for it to be effective by preventing banks from simply shifting their operations overseas?
I think that's very important, but I have to say it can possibly be overstated. Moving your offices, moving physically offices overseas is very difficult, I think. Clearly, there are personal issues involved, for example, as well. But certainly some of the trading businesses, which don't really are probably a lot more volatile, clearly that potentially does have the implication that it could move to other jurisdictions and therefore, take trade away from some of these countries.
Now, last week, European leaders agreed to publish the results of stress tests showing the financial health of individual banks. How credible do you think these tests are going to be? Will we discover where the so-called weak links in the system, the toxic banks, are, gauge the true extent of this crisis?
Well, it's absolutely critical that they are effective, I think, here. That we're talking about some of the largest financial institutions, I think it's the top 26. It's very critical that these stress tests are both stressful, they're credible, they are relevant. I think that's one very important thing. They have to be relevant and they have to be transparent. Now, you'd imagine the European authorities have followed the US model, which I think is genuinely conceived as a turning point in terms of being able to bring confidence back to the US banking system. You would expect, I think, that the European authorities, politicians, regulators understand that, and they understand the importance of getting this right. And if there are holes that arise, then clearly they need to have some sort of backup plan, some sort of funds available and there for banks to be able to draw on.
Very briefly, European banks hold billions of pounds in Greek, Italian, Spanish, Portuguese bonds. Just how important is it to remove these doubts about the banking industry if we're going to resolve the effects of the banking crisis? How difficult is it going to be to restore market confidence in the banks?
Well, this is certainly one critical thing. I think this potentially, if it works, could be a turning point. You're right that obviously banks do hold government bonds. Actually, interestingly, Eurozone banks own an awful lot less government bonds than their counterparts do in the US or Japan, for example. In the region, across the Eurozone on average, roughly about 7–8% of banks' balance sheets are in sovereign debt. But all the same, it the sovereign concerns, the risk that brings to as well, that sovereign concerns can translate into further economic downturn. Certainly these are weighing on the market at the moment, and restoring confidence is absolutely critical, and the stress test could certainly be a way of doing it if they're managed well.
Well, thank you so much. We do appreciate your time. James Longsdon there in Singapore from Fitch Ratings.